Well, after wild swings in the market, stocks finished out the first positive week since November on Friday. Despite the overall upswing, the market closed mostly lower on Friday, with the Dow and S&P both losing some ground. The tech-heavy Nasdaq bucked the trend and made a modest increase. But the 1 day of trading left in 2018, it looks like all three major indexes will finish the year lower than where we began. For more, Newton Stacy is a market analyst and director of portfolio strategy at Optimal Capital. She joins us now from Reno, Nevada. Well, Francis, after making gains in the past few years, why did the market take such a turn near the end of 2018? Do we know what's causing the volatility?
Yes, absolutely. So anytime that the Fed tightens, we lose money out of circulation, and the stocks are extra money in circulation. When you think people have to pay their mortgages, they have to pay their debt, they have to pay their obligations, and they can only invest in the stock market with extra money. And so when you start removing some of the extra money out of circulation, there's a little bit less to go around, and it creates a lot of movement in the market, which creates the volatility.
How concerned should investors be?
They should be concerned. If the Fed is going to continue to tighten next year, they should certainly be concerned. They haven't actually come out with they've sort of backwalked the statement that they made that made the market fall 650 points about the rate hikes next year. So they're saying now that they're a bit more data dependent. The president of the New York Fed said that. But their balance sheet normalization, which I know sounds very confusing, but again, it's just taking money out of circulation, is the thing that's going to keep the system very tight, which means volatility is going to remain high.
Usually we see the stock market getting somewhat of a boost around the holidays. Why wasn't that the case this year?
This reason exactly, particularly the Fed statement right before Christmas. I think it scared people, and I think it unnerved people. And Trump's reactions to the Fed statements, I think, are very unnerving for investors. And so I think in the new year, he said he's going to go talk to Powell, and I think they're going to come out with a statement that shows investors that they're not particularly at odds, and we should see things hopefully calm down at that point.
Is there any way to gauge, based on market indicators, how the 2019 year might be for the economy and also for Wall Street?
Well, the economy, the numbers that the Fed pays attention to, so the jobs, the unemployment rate, some of those numbers and the growth rate certainly are lagging indicators. So anytime money works its way through the system. So if you grow the money supply, it has a certain amount of time where it works its way through the system, and you don't necessarily see a reflection in the numbers right away. It's the same is true with taking money out of the supply, and you don't necessarily see that right away. So the stock market is a leading indicator. So the economy is always going to follow the stock market. And right now, unless they can lessen the volatility, from a technical standpoint, if you can get the Dow closing above 25,000, that's a very good sign. And if you can get the VIX down below $25, that's also a very good sign that things are going to be a little calmer.
Some analysts are saying that this downward trends that we're seeing are signaling that a recession is coming. Should we be worried about this? And can anybody really tell for sure?
Yes, I think that if the Fed continues to tighten, again, that's taking money out of circulation, then it's going to be harder to service the record amount of debt. We have a new record debt worldwide, 250 trillion. That number came out yesterday. We have 21 trillion in public debt. We have record amounts of debt in almost every place in the system, $9 trillion in corporate debt. So what happens, again, you remove money from circulation, and there's a little less to go around. The debt's more difficult to service. Now, if we have no problems in the credit markets, meaning no major defaults or anything like that, I think we can stave off a recession if they slow the rate of tightening, and that just means, again, taking money out of circulation. Or I think if we do see credit problems, that guarantees a recession.
So for people who aren't invested in the stock market, but maybe they have a 401k or maybe another retirement fund, what impact do you think this could have over the next year for that?
Well, it depends on how they're allocated, right? What specific instruments they're in. Equities don't do very well in times of Fed tightening. You can go back through all of the iterations of Fed tightening. Equities don't perform very well. So the most traditional thing to do is move over to bonds. A little bit of the problem with bonds is the yields are still quite low from a historical perspective. At our firm, we use all kinds of different tools to take things off of the attention of the stock market and potentially go in a non-correlated direction or a different direction entirely. But I would say to anybody out there with a 401k or anybody out there with a financial advisor, go in and ask your advisor to be defensive and watch for news about credit defaults, whether it's student loans, subprime auto, corporate bonds, because that's going to be a drag on the system for a longer period of time until all of those credit problems get fleshed out.
I want to ask you about sort of the effects on that. When you talk about market downturn and the economy, when you look at unemployment, when you look at credit cards, mortgages, folks who have that type of debt or situation, how could they be impacted?
Well, they can definitely be impacted because, again, the employment numbers are lagging indicators. So, for instance, a scenario, if you have a blow up with the $9 trillion in corporate bonds, corporations are going to have a harder time hiring. And those people who are trying to service debt, when employment changes, as this sort of works its way through the system, it's going to be harder for those people to service the debt, particularly people with higher debt. And, when we started this Christmas retail season, 28% of people hadn't paid off their holiday debt from 2017. So the system has a lot of leverage, and the more money you take out of the system, which is why Trump is angry with the Fed, the harder it is for all of that money to go around and service that record amount of debt. So that's going to be the key going through 2019. Are they tightening, and what is the rate?
Frances Newton Stacy, thank you very much for joining us with that financial preview.
Thank you, Rena.